guest, Mr. Michael Refollo. Michael is a specialist in commercial law and a partner of americanskого company. Correct. Okay. And subject of today's lecture is from startup to become a public company in the United States of America.
Thank you so much. Thank you everybody for coming. I haven't done anything yet. So lucky you, this isn't actually a lecture where I only talk to you, and maybe each of you is going to speak today. So did you know that's what you were bargaining for? Let me get my notes. Because what I find most interesting in business law or corporate law is not how things are different, but how things may be the same. And it could be that everything I say, or a lot of what I say, is what will actually, or what actually goes on in Russia. And it could be you say, well, gee, they do that like this in the United States. Why do they do that? That makes no sense. We have it better here. Or you could say, well, gee, I've never thought about that in doing it that way. And maybe we should discuss or think about ways to do that in Russia. And so I think it's really important or really interesting to less that this is how it's done in America, but try to think for yourselves, is this how things are here? If not, why not? And if not, why? So I was trying to figure out how to use this clicker here. So I don't, is it just the right click?
Just hold the mouse.
It's
mouse.
Left. Yeah. So, anybody here start a business? Nobody. No entrepreneurs in the house? Does anyone have a family member that has a business, that owns a business?
Yes, my mother has own business.
And what does your mom do in her business?
My mother sells products.
She sells products.
Yes.
You want to say what kind, or?
Clothes.
Clothes? Good. Anybody else have a family member who owns a business?
My mother has a business. She sells lights.
Lights.
Yes.
Lighting. Very interesting. Anybody else? Anybody want to start a business someday? No entrepreneurs in the room? Well, whenever you start a business, you have to decide what it is. What is that idea? What is it that you want to start to make things better and to improve the market somehow? And it could be that there's demand for lighting or demand for clothing, and therefore, and you have a great market. It could be retail. It could be wholesale. Do you guys know the difference between retail and wholesale? In a retail market, that's when I'm selling it just to the consumer, the person who is buying the good. But when you sell something at wholesale, that means you're selling it to another company, and that company sells it to a consumer. So there's anywhere in that chain, the market, you could be the idea or the goods or the products. So it's not always lighting and clothing. It could be a service. The hottest thing in America right now is, and if you talk to any student your age, everybody wants to create the next app, right? If I only come up with the app, I can make $1 million. Does anyone want to design an app or have a good app idea, application for an iPad or an iPhone or anything like that? Nobody. Nobody likes creating, doing computers and working with computers. All law students, huh? I'm going to get you guys to talk. You don't know it yet. So, in starting a business, you're either going to have products or goods, services, or some combination of that. But the real question is, do I even need protection? Do I need to form a business when I'm creating when I have an idea, when I'm selling a good or service? So the first thing you have to ask yourselves are, what are the risks in running your business? So I'm not going to pick on these two guys. I'm actually going to have you guys think about what they're selling. So who wants to volunteer? What is the risk to selling clothing? Anyone have any ideas?
Yeah, fashion is always changing, so maybe 1 year it's popular thing, popular maybe t-shirt, and next year
Out of
nobody
style.
wants to buy it.
Right,
Yeah,
right.
So it's a problem with
Right.
clothes, for example.
And what happens to the owner when that risk?
Yeah, problem with the owner, he bought really a lot of clothes and nobody wanted.
I say, I want to do business with you. I say, well, before I share anything with you, I need you to sign this agreement. And this agreement says that what I share with you is confidential. If it's not if you don't keep it confidential, I can sue you. And all in doing businesses, buying and selling businesses and starting new relationships, we all enter into, at the outset, at the very beginning, a confidentiality agreement. Because without it, we have not protected our goodwill. Next is a non-compete agreement. Anyone know what that might be? Just check time. Anyone know what a non-compete is? Well, if you hire employees, yeah.
Like as employer, you shouldn't go to another company.
Excellent, yes.
Compete with me. For example, Google and Microsoft, as I know, both have such conflict.
Exactly. So, if I hire an employee, my employee becomes part of my goodwill. And my employee has all this know-how. So if my employee then quits and joins another company and shares my know-how, well, I've lost my goodwill. So the employee has to sign a non-compete. I will not do the exact same thing. I will not sell pens. And I will not sell pens to those same suppliers for at least a year after my job. Non-competes are very controversial because you have personal rights to work wherever you want to work. But you cannot do that by taking somebody else's goodwill, some other corporation's goodwill, and bringing it to the next company. Very common. California, one state of California is the only state that bars non-competes altogether. So it's fairly controversial to have a non-compete. A non-solicitation, any idea what a non-solicitation is? It's a similar concept, but it's a little different. Any thoughts? When you solicit somebody. So a non-solicitation is another protection where you cannot solicit my employees and you cannot solicit my customers. If you do, you're in breach of that. That's how I protect my goodwill. I'm sharing with you information about my company. You can't now just dial them up and say, hey, I think I could work with you. You cannot now take my employees away from me. That's a non-solicitation. That is not that controversial. It's very common. And it's a way to protect my goodwill. And another way is simple, a domain name registration. Anybody out here have a domain name?
It's a personal name, it's a nickname or thing.
For a business though.
For a business, of course, it's the name of the company,
Yep.
for example.
Yep. Obviously the name of a company is all part of your goodwill. And if you don't protect your name, you don't have your company anymore. So if you register the name with the internet, it's really hard for others to get it. So folks, will take a domain name, the name of the company, and they'll get a bunch of other names all around it to protect the goodwill. So those are the means of protecting your goodwill. Does it make sense that you have to protect your goodwill? Think about it, if you're representing somebody, representing a company, and they know nothing about protecting themselves from a goodwill standpoint. These are the kinds of points you'd want to bring up, right? Wouldn't that make sense to say, well, gee, how are you going to protect yourself from a goodwill standpoint? Very important. There are other ways to protect intellectual property. Intellectual property could be software, could be an idea you have, an invention. So, say this water cap, has that little piece that comes down on the bottom. Well, somebody came up with that, and for all I know, it's patented, right? And what that means is, if I came up with that idea, nobody else could do it, so long as I filed a patent with the U.S. Patent and Trademark. There's patents everywhere, as all over the European Union. Do we have the concept of patent in Russia? Yes. And so the best thing about a patent is that you now license your technology. And if you knew enough to patent your technology, you will get a royalty, money, for the patented item. Similarly, a trademark. Anyone know what a trademark is instead of a patent?
Like a certain sign of the company, maybe, or the sign of the product, for example, it's going to be like Apple, for example,
Yes,
a trademark.
Absolutely. Yeah. It's your name. It's who you are. So we file that trade name, the name of the company, with the trademark office, and that means don't touch this. We own this name. Let's see if this has it. Yep. So I have this Bon Aqua, this drink right here. And there's an R with a circle on it. Anyone know what that R with a circle means? Have you noticed it before? Right there. See it with the glass? Yeah, right? You see it? R with a circle. That means this company decided, Bon Aqua, they want to protect this name. They want to protect goodwill. So they registered the name with the U.S. Patent and Trade. And when you do that, you have the right to put an R with a circle. If you don't do that, you don't have a right to put the R with a circle. You could put a TM, but you can't put an R with a circle. And that's the difference when you see, if you start to look at bottles and drinks, just look. You'll see the R and you'll see the TM. And you'll know now what that means. That means somebody registered it or didn't register it. Make sense? Even if you don't register your trademark, you still have rights to it. It's just that when you register it, you're telling the whole world about it. You're saying, this is mine, guys. Don't touch it. This is mine. The other way to protect yourself or intellectual property is by assignment. An assignment means that when you are inventing something, you own it. Even when you're an employee. As the employee, you have to assign over all of these rights to the corporation. If you don't sign, if the employee doesn't sign an assignment, the company does not have the ownership of that patent. And while the employee may be very happy about that, the company's not so happy. So you need paper in place to assign it. So, let's talk about money. Guys like money? You're starting a business. Who wants to be my mock business starter? One of you guys want to be a business starter? An entrepreneur? No? Would you like to be an entrepreneur? It's not going to be difficult. You willing to be an entrepreneur? All right, good. Any idea, anything you're willing to sell, something you've always wanted to do, say? Forget about law. Drop that completely from your life. Something you may say, well, gee, wouldn't it be cool?
Maybe books.
Books.
Yeah.
All right.
Oil and gas.
What's that?
Oil and gas.
Oil and gas. All right. Very good. I got two entrepreneurs. I have competing entrepreneurs, books and oil and gas. And we're going to start with you. Okay, let's start with books. How are you going to start your business?
So first of all, I will think about which kind of entity I want to start to register. If I am going to do it like by myself or if I want to have a partner.
Excellent.
Yeah, and
What about
Money,
money? Is
yeah.
that a universal
Maybe
sign?
I already have some money to start my business, or maybe I need to look for investors for my business.
Yes, right? You need money. How about oil and gas? That's a big picture, right? Where are you going to get your money from? Right? You're not going to get profit right away, right? You need money. So you may have personal wealth, in which case, good for you. You put it into your business. And you risk that money, but you put it into your business. Maybe you could find a bank, but you know what? Banks don't like to invest in new businesses because they're very, very risky. So it ends up being your personal assets anyway. You're signing a guarantee, and they're taking a collateral. Collateral is they're going to basically, if you don't pay, they own your whole business. But those are the traditional ways of ways to support your business. But other than being very lucky with personal wealth, or being very lucky that a bank would actually think your idea is so good they're willing to take the risk with you, which is very unusual. Banks do not like risk. You're on your own. You have to find investors. If a bank does give you a loan, they're going to ask for personal guarantees, so it kind of unwinds the whole idea of having an entity in the first place. And they take what's called a UCC, Uniform Commercial Code. They take an interest, a lien, on the personal property. So the desk, if you don't pay your loan, they can take it all. They can take the desk, they can take the computers, they can take the customer base. It's all theirs. Next, though, how does a company raise capital? We seek investors. We talked about that, right? That's the way we do it. What types of investments do investors seek? So, a corporation. Anyone know what stock is? Anyone give me a word for stock? The corporation sells interest in something, own a piece of it? No. A corporation sells interests, so it has shareholders. So if I want to start a business, I could go to 10 friends and say, will you own a piece of my business? And they say, yeah, right? I said, okay, well that's $100 a share. They go, oh, I don't think I wanted to do that. I said, what are my rights? Well, you get a right to vote. You know, you have a say in the business. Oh, that's not bad. What else do I get? Well, you get, let me think. If I make money and you own 1% of the business, I'll give you 1% of the profits. Oh, that's not bad. What else? Well, if you sell the business, I'll give you 1% as well. And the stockholder will say, well, I'm ready to give my $100. I'm ready. Not good enough deal. Why isn't it a good enough deal? Would you do it? I have a good idea, a really fun idea. Actually, oil and gas. So if you just made your business plan, right? Sounds cool, pie in the sky, oil and gas. Start your corporation. You seem like you know what you're talking about. You got 10 friends. Can you convince them to give you money?
No. This is a real idea.
What's that?
This is a real idea, I think.
Not realistic. But you may be able to convince people if it's a good enough business plan and you sweeten the pot a little bit, give them a little extra. Maybe that 1% becomes 2% even though I only invested for 1%. Maybe that 1% becomes 3% even though I only invested 1%. Well, now I'm willing to maybe turn that money over, right? Because I'm giving money over, but I'm taking on risk, but I'm getting a bigger upside if I take that risk. That's a common reaction to say, ooh, I'm willing to take that risk for the upside. So when you offer a preferred stock, that's exactly what that is. Preferred is you get preferences. You get a little extra on that sale. You get a little extra on the profits, more than what you put in the first place. An LLC, a limited liability company, has the same idea, but they call it membership interest. But it's all the same concepts. Whether it's a corporation or LLC, you could get that. And then we have something called a convertible note. Anyone know what a promissory note is? A promissory note, a loan. Anyone know what a loan is? A promissory note is when someone makes a loan to you, you borrow money from somebody and you owe them money back. So if I give you $100, I say I would like $100 back, and I want a little bit of interest. The interest would be 5%. So when you pay me in full, I want $105. Make sense? I'm sure you guys have all dealt with loans before, right? No one borrows money anywhere. And so, what's that? Anybody borrow? Anybody do loans? So a convertible note is just a spin on that. It's a loan that converts into stock if I wanted to. So I get as a creditor, I get the best of both worlds. I get my money back plus interest, or I could say, wait a second, I want to turn that money into stock because this company has really done well. So oil and gas, if your company, you have your business plan, I give you $100,000 US. I want 10% interest because I'm being greedy and it's high risky. I'm hoping for $110,000 back. If I don't get $110,000 back, I get your whole business.
So you became the owner of the company.
Yep. And then, your business is really taken off, it's done really well, and it's going to convert into stock, even better deal at 20% of the company. If you sell this successful company, I'm going to get 20% of the company, and I really had a great upside from my investment. So it's just another way to invest in money. What do you?
Like a warrant, like guarantee, to guarantee something.
A what?
What?
A guarantee, you say?
It's like promise to buy or to sell some stocks or any securities.
That's right. It's a promise to, you set a price and you say, hey, you're a fixed price, you're an employee, and you say, hey employee, I don't really have a lot of money to pay you, but I'm willing to give you an option. An option and warrant are really the same, except that an option is more for employees and a warrant is more for investors. So I go to my employee and say, I don't really have as much to pay you as I'm hoping to pay you, but I'm willing to give you an option. And the option is, you could have 10% of my stock, 10% ownership of the company, and you have to buy that 10% for $10. But you get the option. You don't have to buy it. And 10 years from now, you could choose whether to buy that stock or not. You get the look back. Has the company risen in value? Is it worth now the $10 because it's worth $100? Does that make sense? So it's the value of that look back. And if I went to you and said, I'm going to give you a salary, but it's pretty low. But on the upside, I'm going to give you an option. And you have 10 years to exercise that option. Is that something you would consider at least as part of working for somebody? Yeah? Yeah.
It's good for future. It's
Right.
very simple, but
Yeah.
it's a good idea.
Well, I can tell you in America, nobody refuses an option. Because why would you refuse it? They're only going to, you may choose to say this is not enough salary, but you wouldn't refuse that option. You say, I want my option. Does that make sense? Yeah.
It works for top management in Russia. Such
For-
mechanisms.
It works for what?
For top management.
Top management. Yes. So it's very common for upper management to get options as part of their total compensation package. So you would get your salary, you get benefits, health insurance, maybe you get a bonus if you hit certain thresholds or numbers, and you also get an option being that look back for compensation. Usually options have a 10-year maturity. Let's see the option. It would be a common way to try to get money to start your business. And maybe they're going to be a little more flexible in wanting all that extra 2%, 3%, right? They'll be a little bit easier on you. There's a new concept called crowdfunding. Anyone know what crowdfunding is? Yeah?
In 2012, Barack Obama signed the special act.
Yes.
Jobs Act.
Yep. Job day.
When, as I know, the provisions about crowdfunding is not enforced.
Yeah, they're having a real hard time figuring out how to regulate crowdfunding. Anyone know what crowdfunding is? You thought you might know crowdfunding?
Yes, it's when you collect money from common people for
Yeah.
the great idea.
Right? So you go on the internet and you say, I have this idea, right? And I would like to collect some money for my idea and I'll give you something for it. It's not regulated yet, it's a new concept, it's a way for everybody to invest early into a company. And they've really taken off, the concept of crowdfunding. Anyone know any crowdfunding sites?
Kickstarter, yes.
Kickstarter, yeah, that's the most popular crowdfunding. So that's all the rage right now. Everyone talks about crowdfunding as a way to help start the business. Hedge funds. Hedge funds is really a bunch of investors who put their money into a fund, and there's a fund manager, and the fund manager says, makes decisions as to what new companies to invest in. You guys have hedge funds? Big mutual funds or something? And venture capital firms are a similar concept. They are professionals who will listen to your plan, your business plan, and they could listen to oil and gas, because it's a big picture. You probably need a venture capital firm, and they will say, well, gee, how are you going to make this happen? You're at this point a highly polished professional. You know your business, you know the risks, you know the competition to your business, you know everything that's going to go on in your business. You've got top management, you've got educated people working for you, you've got your whole business plan. Well, a venture capitalist will look at that and say, I'm in, I'm going to make that bet, but I want a third of your business. And they're going to give you start money, but I need a good chunk of your business. They'll usually also put a representative on your board of directors. So if you go to sell, they would get 30% of whatever it is you create.
Okay, for Russian state company, Russian venture company.
There's a state-run capital.
We have such a
Yeah. We also have, in America, we have some kind of guarantees. The U.S. tries to stay out of private corporations, private ownership, but in order to create jobs or improve jobs, the U.S. will sometimes guarantee loans or guarantee capital, so to enable the job creation. Next, how do you raise funds in the late stages? Anyone know what an IPO is? Yeah? Initial public offering. What that really means is you're issuing securities to the public. And that means in the big picture. I'm going to send around the document here. This document is called a prospectus. And it's a filing that you do with the regulator, with the government, and it's a Securities and Exchange Commission. I just grabbed this out of a pile that we have. And that's called a prospectus. What it does, what a prospectus does is describe the company. It describes all the risks of the business. It states what the executives are making, very public, the salaries of the executives. It states all the financial statements. It gives all the financial information about the business in a highly required, regulated way. So it requires SEC registration. It's filing that document. That's what that means. And a roadshow. A roadshow is when you go out on the road and you try to find underwriters, people who are willing to invest in your company, companies that are willing to invest in your company. And then you also have secondary offerings. Secondary offerings are after the initial public offering, you still need money, you need capital, and you do a secondary offering. So, securities laws regulate capital. As I understand it, it's not like a securities law concept. There's securities law clearly, but not a separate degree for securities law. But in America, securities law is a really big piece of what a lawyer does. In part because you have to get that filing correct, that prospectus correct, the disclosures. But the federal law says that I could find 10 investors, and those 10 investors, if I don't have an exemption, I have to actually file that document. So I need an exemption from that, because that document is way too big. The exemption is called a private offering. We have something called Regulation D, and if you get accredited investors, certain investors that are at a certain high level, those investors without risk can invest in your company, and I don't have to give them that whole big document. I could just give them something small, a private offering memo, something light. Why? Because those investors, by their wealth or by their salaries, are at such a high level that they know what risk they're taking on. You're not taking advantage of anybody. What does it mean to be an accredited investor? And we'll do a quick conversion. It's $1 million. You have to have $1 million in net worth, so that's 60 million rubles. 60 million rubles. 60 million rubles net worth. Or you have to earn $200,000 in salary. So quick math on that would be 1.2 million or so in rubles. Or with your spouse, your wife or spouse, or husband, 300,000 in. So these are high income people. These, even in America, that's actually are upper 1% of what people earn. So that's an accredited investor. They are sophisticated enough by their salaries and by their education and degrees that they would be willing to take the risk. And you don't have to give them the big prospectus. They're exempt. But if you do have to register, you have to do that prospectus. And that's on a specific form called an S1. And annually, you have to file a 10K, which is that prospectus updated every year. And every quarter, every 3 months, you have to file a financial statement and describe what went right and what went wrong with my company this quarter. It's quite a burden on the company, but that's what it means to be public. The states also like to get in on the game, so all 50 states have securities laws. And if you issue shares to a person who lives in the state of Massachusetts, you also have to look at the state of Massachusetts laws, securities law, and perhaps do a filing with them as well. So it's 2 levels of regulation. There are other ways to go public without doing an IPO. And those ways would be, you just got too big. You became such a successful company, and you had so many shareholders that were accredited, but you just got so big that you're now a public company. And in that case, it's 2,000 shareholders and $10 million US dollars in assets. You could also say, well, gee, I just want to be public. And you could file that prospectus and just decide to be a public company. Why wouldn't you do that? You've got to have audited financials all the time, very expensive. You have to do these disclosures, you have to pay for attorneys, which is expensive. And so it's not something you would normally voluntarily do. But you can do that. Why would you want to be a public company? Well, it's a lot easier to raise capital. You're on the markets now. You're on the public company markets. Another way to become a public company is called a reverse merger. There are public companies that did all the filings, they did everything right, and then they failed. And so now they're essentially a shell company, or just a little bit of what they were supposed to be. And it could be they say, well, gee, you're already all set up. Can I merge my company into your company? And by doing that, now I'm a public company? They said, well, sure, I'll give you 90% of the stock. I'll issue new stock. I'll give you 90% of the company. I keep 10%, or my shareholders keep 10%. And now we have a viable company again, all set up for a public company. So a reverse merger is a common way of becoming public without doing an IPO. And the next is called a direct public offering. You couldn't find that underwriter, somebody to kind of pay the money up front and sell the shares. So you just said, hey world, I'm doing an offering. Here's the money. I'm looking for money, but I'm doing the filings that you have to do. So the requirements of a public company. Does anyone know what audited financials are versus not audited financials? Anyone ever seen financial statements before? Financial statements are what accountants prepare. They show a balance sheet, and the revenue that comes in, and your profit, all right? And it shows your cash flow. And then there are a lot of notes at the end which describe the business.
Prepared by accountants.
The accountants,
Such reports.
yes. And then there's audited financials. Audited financials means they fit certain criteria under GAAP,
US GAAP.
US GAAP, yes.
Special reporting.
Right, and it's very expensive to have GAAP audited financials. But GAAP audited financials are mandatory for public companies. Why? Because everyone needs to know that when they're investing in a public company in the US, that everyone is describing the same rules. That when you say revenue, we all know what that really means. When you say profit, we all know what that really means because it was driven by the GAAP rules. But it's expensive to do that. So PwC, Deloitte, all those big companies that we see here, that's what they're doing. They're doing GAAP audit, GAAP-like, if there are other standards in other countries, but GAAP audited financials. It's a very high level of financial statement reporting. There are also legal costs. There's lawyers always checking the securities laws. So lawyers do very well as securities lawyers. It's a very high-end lawyer. There's information for shareholders that you have to give out, like this prospectus. And there's restrictions on insiders. Anyone know what insider trading might be? What that could be?
Secret information. And if I'm a member of board of directors,
Right.
I sell it, so I break the laws.
Right.
Because I give to another people secret information which have our movements on market.
Right.
Buy, sell.
Right. So what does that all mean? So if I hear some secret information about a company that they have not disclosed in this report yet, and I decide to give you a tip, should you buy it? You would buy it, right? Okay, and then you tip the family member. Should they buy it? It's information, it's good. It's good information. I promise you it's good information. So who'd you buy the stock from? You don't know that person, but did they know the information that you knew? They did? I gave you the tip. They don't know. So the question becomes, is it fair? Is that fair? You got the tip and you bought. Is it fair to trade on that tip? Anybody think it's fair, not fair?
But I know there are responsibilities for insider's information in the USA especially.
Mm-hmm. Mm-hmm.
I think
In the United States, anyone know Martha, what's her name? Martha Stewart? Anyone know Martha Stewart? You knew her. How do you know her? That's scary, right? Martha Stewart is a woman, entrepreneur, who specialized in preparing foods and making a good home. She's a savvy businesswoman. But she also knew how to market herself on making things look good. So a table setting, the curtains, right? And she would do shows just on how things would. Well, she also owned a clothing line, and she was accused of trading on a tip. She knew there was bad information about her company. She decided to sell all her stock before the bad information got out. And by doing so, somebody lost money, and Martha Stewart got to keep her money. Is that fair? The answer is a big no. Not in the United States, at least. You cannot take advantage. Everybody has to be on equal trading. You cannot take advantage of a tip. And if you do take advantage of a tip, you can go to jail. So Martha Stewart went to jail. Wasn't forever. It was 2-3 years. Martha Stewart went to jail. Can you imagine the gravity of that? So that's insider trading. There are other issues, which is reporting issues and short swing profits, which means that if you're a director or an officer, you can't buy and sell and buy and sell. You can't keep making these profits because you kind of have a feel as an insider of the cycle of the stock price. And you can't take advantage of that. And next, in order to sell on an exchange at this high level of stock, you have to have brokers, people who are willing to sell stock for you. So if you have what's called a stock ledger, you have a corporation and you have stockholders, say there's 500 stockholders. Well, the corporation's not able to constantly do that. You need a broker to do that, right? To sell the stock and buy the stock and sell the stock. So you take those 500 stockholders and you put it in the name of a company called CD & Co., Depository Trust Company. And they get one certificate and they break down that stock into a bunch of accounts instead. And those accounts are what are crossing and buying and selling. Does that make sense? Because it would be too slow for the corporation to do it. So you issue one certificate to CD & Co., and all the brokers are able to trade. You have to have all your stock in CD & Co. in order to allow that trading. And if you allow that trading and you hit certain dollars, for instance, if your stock is worth, say you have 10 million shares and your stock is worth $2 a share, then you have met the listing requirements to be on an exchange. The common exchanges are NASDAQ and New York Stock Exchange. But even for very small companies, there's something called the OTC, over the counter. There's also words called pink sheets, where you could allow trading through DTC. And then finally, what will be your exit strategy? You created this business, you assessed the risk, you've gotten investors, your investors want to get out, they want to sell big time. What's your personal exit strategy? You don't want to work forever. You could do the IPO and you're cashing out. You're giving up a piece, but you're also getting cash out of your business. You could just sell all your stock and say, I'm done, but here's my company. Or you could sell your company. The company can merge into another company and you're cashing out that way. So, have I converted any of you into business lawyers based on all that? That's all I have. If you guys have questions, I'd be happy to take any questions.
Can you repeat some information about how we can register a sole proprietorship in USA? And should we register it?
Yeah, the sole proprietorship is your most basic form of business in the USA. So all you have to do is file a little $25, it's really 200, 300 ruble document with the town that you work in. Just to say, this is my name and my business, and that's all I am. By doing that, you haven't gotten very much. You haven't gotten yourself protection. You're really not able to get investors. You have no partners. Very simple form of business. But works. Most companies are sole proprietorships. It's just people selling clothing or shirts, or there's very little risk to the business, and therefore they have a sole proprietorship.
Thank you.
When you think of the oil and gas example, it's the polar opposite. It's the exact opposite, right? Oil and gas, oh my God, the explosions, the leaks, the environmental concern, contamination in the deliveries, the exploding trucks, right? You can think of the price fluctuations, the fluctuations between countries, and market fluctuations on the dollar. All of these risks of these businesses, complete polar opposite. Well, you need a corporation. You probably need a public company for that. Any other questions?
Yeah, can you please, what is the type of business entity for your local company?
For mine?
Yeah.
We have a limited liability partnership, and what that is as professionals, we're not allowed, we cannot protect ourselves from getting sued personally for practicing law, so we get insurance for that. But if we were to sign a lease or a contract or have a photocopier, and we broke the photocopier or things like that, we do get protection for those kinds of things. We do not get protection for the practice of law. Similar to doctors, the doctor may have a doctor practice, private practice, They will not get protection from malpractice. Somebody dies because they did a poor job, but they will get insurance for that. But they would get protection for the office space, the lease, and getting sued by an employee, those kinds of things.
So is it the most common way to create a new company in America?
In America, it would be a limited liability partnership. Once in a while, an LLC, I see as well. You're not allowed to have, in America at least, you're not allowed to have owners who are not lawyers. So it's always a partnership type setup.
Please tell us about company de facto in America.
De facto. So I've heard of de facto merger, or I've heard the concept de facto, which means it just happens because it happens, right? But I'm not sure that, I've heard of a de facto merger where it's a merger of companies that just kind of combine somehow, but it's not a true legal term. Yep.
From this marketing, it's better to be a sole practice lawyer or practice in a law firm, maybe, especially in America.
Mm-hmm. So in America, it's very hard to get training as a solo. And if you are a solo lawyer, you're often doing real estate closings for houses or very simple wills. In America, at least, the training and the education is terrific. However, it's not practical. So in America, you never get to write a prospectus, right, for instance, or you never get to draft a will. You talk a lot about case law and common law and philosophy and thinking and balancing and risks and things like that. But in the practice of law, it's all about the paper, right? Right? So when you have paper and it's writing a contract, you say, how do I write a contract? Well, in America at least, you need mentors to teach you that. You need to say, well, I would never put that in a contract because this is what I'm worried about when that's in a contract. And someone else will say, well, no, I always put that in my contract because that's the best provision ever. And you're deciding for yourself as you're listening to all the different opinions what you would do in that situation. What risk? It's your client. What risk? How do you want to describe to your client what this contract means, right? So for me, I've always practiced in a mid-level size, 60 lawyers to 150 lawyers, because of the mentoring that you get from that. But there are lots of successful lawyers in a smaller firm, and also big firms sometimes will have folks who leave the big firm and create a boutique. They've been trained, they're in a highly specialized practice, but 10 lawyers will say, we just want to do this by ourselves. They didn't like the full partnership, so it's a specialized practice, small firm, but a boutique, very highly, that's what trained lawyers. Any other questions? Okay. Well, thank you, everybody. Thanks for having me.